prices of production is a concept in Karl Marx's Critique of Political Economy, defined as cost price plus average profit. It refers to the price levels at which newly produced goods and services would have to be sold by the producers in order to reach the normal, average profit rate on the capital invested in producing them. The importance of those prices is that a lot of other prices are based on or derived from them. They determine the cost structure of capitalist production. A production price for outputs in Marx's sense always has two main components: the cost price of producing the outputs and a gross profit margin. Marx's argument is that price levels for products are determined by input cost prices, turnovers and average profit rates on output, which are in turn determined principally by aggregate labor costs, the rate of surplus value and the growth rate of final demand. The suggestion is that differences in profit rates among producers will tend to level out as a result of business competition, so that a general norm emerges for the profitability of industries. Basic explanation: the regulating price of a given type of product is a sort of modal average price level, above or below which people would be much less likely to trade the product. If the price is too high, buyers cannot afford to buy it, or try to get cheaper alternatives. If the price is too low, sellers cannot cover the costs and make a profit. So normally there is a limited range of prices within which the product can be traded, with upper and lower bounds. This price level is determined by cost prices, profit margins, and sales turnover. The production price then refers basically to the normal or dominant price level for a type of product that prevails during a longer interval of time. It presupposes that both the inputs and the outputs of production are priced goods and services, that is, that production is fully integrated in fairly sophisticated market relations, enabling a sum of capital invested into it to be transformed into a larger sum of capital. In pre-capitalist economies, this was not the case. Many inputs and outputs of production were not priced. Marx's claim is that the production prices of products themselves are fundamentally determined by the comparative labor values of those products, and therefore are constrained by the law of value. Since, however, not all goods are produced or reproducible goods, not all goods have production prices. A production price in Marx's sense can exist only in markets developed sufficiently for a normal rate of profit on production capital invested to become the ruling average for a group of producers. Substantively, Marx argues that the prices of new products sold will, assuming free competition for an open market, tend to settle at an average level that enables at least a normal rate of profit on the capital invested to produce them, and, as a corollary, that if such a socially average rate of profit cannot be reached, it is much less likely that the products will be produced at all. Marx defines the general rate of profit as the average of all the average profit rates in different branches of production. It is a grand average profit rate on production capital. According to Marx's theory, investment capital is likely to shift out of production activities where the rate of profit is low and toward activities where profitability is high. The leading sectors of industry are those where profitability is highest. The precondition is the free mobility of capital and labor, and thus there is a systemic tendency to remove all obstacles preventing investors from investing in sectors where profits are higher. If, for any reason, the free movement of capital is blocked or restricted, large differences in the profit rates of enterprises are likely to occur. In general, the developmental path of capitalist development is determined by the industries where the profits are the best, because the products are in high demand, because of special production or market advantages, etc. According to Marx, the movements of different production prices relative to one another importantly affect how the total cake of new surplus value produced is distributed as profit among competing capitalist enterprises. They are the basis of the competitive position of the producers, since they fundamentally determine profit yields relative to costs. Some writers argue that Marx's production price is similar, or performs the same theoretical function, as the natural prices of classical political economy found, for example, in the writings of Adam Smith and David Ricardo. This is the orthodox Marxist view, based on quotations where Marx says that his concept of production prices recalls the classical idea of natural prices. In this case, Marx's production price would be essentially a center of gravity, around which prices for outputs in a competitive market will fluctuate in the long run. This is an interpretation within the framework of equilibrium economics, which suggests that production prices are really a kind of equilibrium prices. It can be supported with some textual evidence, insofar as Marx sometimes defines the production price as the price that would apply if supply and demand for products were balanced. At other times, he refers to a long-term average price or a regulating price. He does not say precisely how these three different concepts are related. The main objection against equating production prices with natural prices is that Marx's concept of production prices is precisely a critique of the natural prices. According to this argument, there is actually nothing natural about the allegedly natural prices, and more importantly, the existence of production prices does not logically depend on an equilibrium state. If the classical economists talked about the naturalness of price levels, this was ultimately a theoretical apologism. They could not reconcile the labor theory of value with the theory of the distribution of capital. They assumed a market balance without proving how it could exist. The general theory behind the concept of natural prices was that the free play of markets would, through successive adjustments in the trading process, converge on price levels at which sellers could cover the costs and make a normal profit, while buyers could afford to buy products, with the effect that relative labor efforts would be genuinely proportional to relative prices. In the sphere of capitalist production, Marx argues, commodity values are expressed in the form of prices of production, established jointly by average input costs and by the ruling profit margins applying to output sold. It is a result of the establishment of regular, developed market trade. The production price averages reflect the fact that production has become totally integrated into the circuits of commodity trade, in which capital accumulation has become the dominant motive. But what prices of production simultaneously hide, he argues, is the social nature of the valorization process. That is, how exactly an increase in capital value has occurred through production. The direct connection between labor time and value, still visible in simple commodity production, is largely effaced. Only cost prices and sale prices remain, and it seems that any of the factors of production can contribute new value to output, paving the way for the concept of the production function. Problems of interpretation. Different types of production prices. The first interpretative difficulty concerns the existence of various production prices. Most Marxists simply took the concept of production prices for granted, as being more or less the same as Ricardo's idea, and they did not inquire into it in precise detail. They believed that the idea of a production price was simple, obvious and not controversial, so they missed altogether the fact that in capital volume, 3. Marx identified at least 4 main types of production prices. The private or enterprise production price, which forms the starting point of the analysis in the first chapter. This price equals the cost price and profit on production capital invested, which applies to the new output of a specific enterprise when this output is sold by the enterprise. This production price can be compared to the average production price that obtains for a sector nationally. The sectoral production price. This price equals the average cost price and average profit rate on production capital invested, which applies to the output of a commodity produced by a specific industry, sector or branch of production. This is the average production price which applies for a particular type or class of product, reflecting the average return the producers can normally expect to obtain. In his discussion of ground rent, Marx notes especially the differences between industrial and agricultural production prices. The intersectoral production price. This price refers to the sale of output at producers' prices, which reflect an average profit rate on a quantity of capital invested that applies to various sectors of industry. The economic production price. This price equals the average cost price and average profit rate of an output at the point of sale to the final consumer, including costs incurred by all the different enterprises participating in its production. In modern times, costing production in order to establish the expected yield on capital invested in it often involves assessing the whole value chain relative to the price level at which products can be sold to the final consumer. The question then is, how can the whole production of a product, from the factory gate to the final consumer, be organized so that it can sell to the final consumer at a price that the market will bear and still make a good profit? Marx sometimes implies an economic production price when, for the sake of argument, he simply abstracts from everything that happens between the factory gate and the final consumer of a commodity. These different prices are revealed when we study the composition of the cost structure of a product at different stages of its production. One source of interpretive difficulty is that Marx often assumes in his drafts that these 4 types of prices are all identical, but that is true only in the special case where one enterprise sells directly to the final consumer. The reason for this conflation is probably that Marx's real analytical concern was not really with the pricing processes as such, but with the main factors influencing the realization and distribution of new surplus value produced when sales occur. After all, his argument was that competition in capitalism revolves around the quest of obtaining maximum surplus value from production in the form of generic profit income. The question was, how does a sum of capital invested in production get transformed into a larger sum of capital? What are the dynamics and overall results of that process? What are the implications for the process of economic reproduction? Oversimplification in the model. A second source of interpretive difficulty is that in his argument Marx often conflates capital advanced with capital in use and with capital consumed. In his quantitative examples, he just assumes very abstractly, for the sake of argument, that the value of output created equals the sum of capital advanced plus surplus value. The sum of input costs incurred in producing output is equal to the production capital advanced. Fixed capital advanced is equal to fixed capital consumed, i.e., there is no depreciation of fixed capital. All output is sold at once. There is no problem with selling anything. There are no variations in the turnover of capital. The rate of surplus value is always uniform across sectors. There are no obstructions to the free movement of labor and capital. Most probably the reason was that his real interest was in the overall dynamics of capital accumulation, competition, and the realization of surplus value produced, assuming output would sell. He was thinking of grand averages and overall results. The simplified picture does not obtain in reality, among other things because, as Marx himself notes, capitalist competition turns on buying commodities below the value and selling them above the value. Marx's theory is frequently confused with input-output economics and the marginalist theory of capital, in which total inputs and total outputs are always exactly equal, an equality accomplished by treating the factor income, which is gross profit, as an input, so that profit is both a cost and a revenue at the same time. Marx did not talk about inputs and outputs in this double-entry bookkeeping sense, where the source of funds balances against the use of funds. Instead, he was concerned with how a sum of capital was transformed into a larger sum of capital through a net addition of new value created by workers in production. He was not really talking about quantities of input commodities and quantities of output commodities, but about quantities of capital required for commodity production and quantities of capital created by commodity production. If indeed the value of inputs bought was exactly equal to the value of output sold, capitalists would not even invest in production, because they would get no profit out of it. So from Marx's point of view, input-output economics really mystified the capital relationship, i.e., the ability of the bourgeoisie to capitalize on the surplus labor of the workforce in virtue of its ownership of the means of production. Theoretical status of production prices. A third source of interpretive difficulty concerns the question of what kinds of prices production prices really are. Do these prices really exist, and if so, in what way? Or are they only theoretical or ideal prices? What exactly is the average an average of? What does the cost price really refer to, and at what point in the process? Marx talks about production prices variously as theoretical prices, which are equilibrium prices that would apply if supply and demand are equal, regulating prices which function as norms for trade, setting upper and lower bounds for price fluctuations around an axis level, empirical price averages across a longer time interval, obtained by averaging out actual output prices for several accounting intervals. Consequently, it remains somewhat ambiguous in what way such prices exist in reality. The conceptual challenge in modeling is to show how these three variables are related. It could, in principle, also be argued that some types of production prices are empirical price averages, while other ones only express theoretical price levels. Obviously, if production prices are regarded only as purely theoretical entities, then it is not possible to claim also that they really regulate actual prices. A price level which exists only in theory, and not in reality, cannot be said to determine real price levels. In grappling with these issues, it must also be remembered that when Marx lived there was little macroeconomic statistical data available that would enable theoretical hypotheses to be tested and relativized. Marx had deduced the motion of capital essentially from an enormous amount of economic literature he read, but when, towards the end of his life, he toyed with the idea of investigating economic fluctuations econometrically, Samuel Moore convinced him this was not possible, because relevant economic data and mathematical tools did not exist yet. Comprehensive macroeconomic data became available only half a century later. Marx had pointed the way to solving the problems raised by the classical political economists without, however, providing a complete answer. He really believed, though, that a general rate of industrial profit, applying economy-wide to all industries, would be formed, but in truth he lacked the data to prove it. He did not discuss in any detail the difference between distributed and undistributed profit, or tax requirements, and how this might affect profit statements. His discussion was limited to physical capital and labor employed, abstracting from ancillary costs and incomes unrelated to production which enterprises usually have.